population growth, and that has increased demand. Looking at farming real estate, at least domestically in the U.S., as compared to other asset classes, stocks, bonds, traditional REITs, gold, and some others. It's been one of the top performers, and it really depends on, this is from 1970 to 2016. It really depends on what window of time you're looking at. In recent history, farmland's done okay the last 2 or 3 years. Everybody's seen really what's happening with the trade relationships, primarily between the U.S. and China, which has caused a little bit of change in U.S. farmland prices, because most of those farmland prices are dependent upon the rents of farmers, which are dependent upon the price that they're getting for their crops. But now with some of the government subsidies in place, you've seen a little bit of stabilization. And, overall, again, it's a great place, to park some money if you're just looking for appreciation and not high yield, at least in the U.S. Now, if you look into emerging markets where we're located, it's completely different. I mean, you've got very high income off the property, more so than the appreciation, because you've got a very low operating cost here, which is different than the U.S. I'm going to jump ahead of this. Actually, I'm going to stay right here for a second. I mean, and really, this kind of brings up the conversation that is on everybody's mind right now is, what is the direction of the economy going to be? Are we going to have a U-shaped recovery, V-shape, or, in a worst case, an L recovery that's going to take quite a while? So, looking at the performance, for instance, as compared to a public market environment, obviously, land prices aren't publicly traded, so there hasn't been quite, you haven't really realized the effect. Now, I know in the U.S., I'm sitting in Colombia, so the only news channels I get are CNN and Fox, who are always battling each other, so I don't really get the real news. But at least the headlines around the agriculture sector are talking about farmers are losing money. And, that's really a result of their supply chain problems. That's a result of not being able to, distribute their product. Primarily people who are in the service-based sectors, farmers who are supplying, like the Cisco's and the food distributors to restaurants are really suffering. If you're in retail right now, you're actually doing pretty good as an outlet. So, the making the case for non-correlated assets right now in the farmland space, it has really held up true in some categories. Us being in the emerging markets in this space has actually done great. We've had no interruption in supply chain, but some of our neighbors around other countries like Peru and some of the other places have had issues. But it's a real asset. It's a hard asset. It's not publicly traded. Again, it's not as liquid, but it certainly is something that I think everybody should consider as a portion of their real estate portfolio and looking at different opportunities to give you some diversification in moments like now. But going a step further, when you look at agriculture, we all know of the input companies like the John Deere tractor companies, Monsanto's, which we all may not agree with, but those have primarily been the access points to agriculture as an asset class, not just in the real estate, but more so just as a business. But really, you can get exposure in a number of ways throughout the supply chain, and different segments of the supply chain have different business models. This is actually a screenshot from our Ag Investor Guide, which we'll make available. The opportunity supply chain here, and each has a different category. We focus in the growth and processing, but you've got logistical opportunities, import-export opportunities, and wholesale, and they all have their own components to profitability and a whole cash flow analysis of how they're going to make money. If you look at integrating yourself into an investment or a segment of this industry, you really have to look at is it well diversified? Is that particular opportunity or whatever the underlying asset is, what kind of security do you have with that? Going forward and identifying opportunities, when we look at opportunities, we're looking at, for instance, we're in emerging markets, we're looking at climates, we're looking at what are the labor rates in different areas, what are the true risk profiles, and then what is the end commodity and how is it going to fluctuate? Looking at minimum wage or farmer wage, if you will, is a huge component of how successful you can be. The other thing is going to be land prices. If you look at growing a mango farm, for instance, in California, you're going to be paying anywhere between $1,800 and $2,000 to your harvest laborers, assuming that they're legal. And you're going to have, a very low margin if you're just trying to go out and buy property. Even if you hired the best farm operator, your entry cost of, the cost per acre in California, coupled with your labor cost, is going to be very prohibitive. And you always hear about this. Farmers it's a low margin business in developed markets. And that's why you're starting to see a lot of farms converted into housing development, for instance, San Joaquin Valley in California. And they're now pricing real estate there in a per square foot as opposed to per acre, and that's just not viable for an agriculture related activity. But again, if you look in other regions, like for instance Panama on this list, you've got year-round growing conditions, so you have potential for year-round harvest in some fruit categories. You've got lower labor cost. You've got land that's probably at 1/10 the price of what California would be. So looking at the opportunities, a lot of what you see is going to be a combination of all of these different metrics that are going to give you a margin in your business. But looking in developed economies, if anybody out there has ever been to a lot of these places, things are moving very quickly in places like Colombia, Panama, Peru. Things are evolving, and the population, the education level, the agriculture education programs really make a case for a great long-term investment. The other things that you have to be concerned with in agriculture is what is the market connectivity. Logistics are a big deal in things like tropical fruits that are perishable goods. I mean, if you're in row crops like corn and soy, you've got storage facilities, so you don't have to worry about that. But when you look at the higher margin products like pineapples, bananas, things like that. Bananas not so much, but the non-commodity products, you need to make sure that you've got a real estate location positioned with access to market and really being well diversified to different markets, because the prices change throughout the year. This is a great example of the price arbitrage that's available in emerging markets, and for instance, in the tropical space compared to the row crops that are going to be traded on a global commodity price that's publicly traded. If you look at the bottom, all of these products, banana, mango, avocado, pineapple, are all, non-commodity, non-publicly traded, so they have a spread in what the local prices are. For instance, at the origin, like in South America and Colombia, for instance, versus what the price is in Europe. Oops, sorry about that. In Europe or the U.S. So there's a large margin in this, and just the arbitrage of the price of the fruit plus the development cost being a lot lower creates a great opportunity in various spaces. Going over valuation and how you evaluate agriculture property, if you've ever, if you've considered taking a look at this before, it's very similar to evaluating a piece of, cash flowing real estate, whether that would be multifamily or commercial. We use a net present valuation, typically in this space where we're taking the projected future cash flow for a window of time, depending if it's a permanent crop like a tree crop, those trees have a lifespan, so you evaluate them based on the future cash that they will generate, and you discount that by a certain percentage. We typically use a discount rate of 10%, somewhere between 10 and 12, depending upon the country that we're looking at. But again, the price history, back testing prices can give you a pretty good indication of what the future cash flows are going to be, and that's what we do when we assess products. For instance, we're in the lime business for here in Colombia. So if I were evaluating a lime farm, I would go into some of the public registries in wholesale fruit markets. You can do that on the USDA website. You can do that on some of the European website. A great resource is the Rungus market in Paris, which is the largest European market. So you can go back and you can actually search the historical prices of fruits or vegetables, and you can use that as an indicative price. I would use a 12-month trailing price average, and then just project that out using that on how many trees you have, what the average harvest would be, and then you have an idea of what that is. But the important thing is when you look at the value, again, going back to the emerging market conversation, right? Let's just do a theoretical comparison. If you take a 1 hectare piece of land, which is 2.47 acres, take a 1 hectare piece of land that's say $20,000, right? You go out and you buy that piece of land for $20,000 in Panama, for instance. And then you were to, let's say you planted coconut trees on that, right? You have 175 coconut trees per hectare. You know that each coconut tree is going to harvest approximately 150 coconuts, and that's going to give you a number per hectare. You take the local price, which is going to be around 50 cents per coconut, you project it forward and get your cash flows, and then you run the net present value of the calculation, and that number, at least in emerging markets of what we've seen, has been about 3 to 5 times valuation of what the cost of the land is plus the development cost. So, there's a great opportunity to develop agriculture land for appreciation as well. And I think you're going to see more and more people starting to look for this type of asset that's already planted and cash flowing. So if you can go out and develop something, you likely would be able to sell it once it gets to cash flow in 2 or 3 years for a significant increase in what the cost would be. Same concept as building an apartment building or something like that. You go buy a piece of real estate, you put a building on it, you rent it out, and then you sell it to a REIT or somebody else who's looking for the cash flow. So, that's where we see the model. There are resources also available. Most people don't know anything about agriculture. 5 years ago, I didn't know anything about agriculture, and but there are farm management companies that are available to be able to manage the operation. We just actually purchased a farm management company here because we've been growing significantly, and that's something that we want to get more in the business of, or the service related activities of that. So there's a lot of resources out there, but just from a conceptual overview, that's the mechanism for valuation. I don't know. I'd like to kind of open this up for questions, because I didn't want to go too in depth, because I really didn't know what people's education level in this space was versus other asset class. So I know we were supposed to go for an hour, but I'd really like to open it up for Q&A and just talk more about what your questions are related to this space, if you have any.
So is there any kind of a tax benefits actually in investing in the farming land?
Yeah, actually, there are a lot of tax benefits. It depends on the domicile that you're located in. A lot of countries have tax exemption for foreign direct investment for a period of time. For instance, in Colombia, you have a 10-year tax exemption here. If you were to buy a piece of land, any money that you put into the property, you would have a 10-year tax exemption on EVA tax and also income tax. Panama has tax subsidy credits, where if you were an exporter of fruit, for instance, the Panamanian government will give you a certain amount of tax forgiveness based on the number of kilos that you export. So it really depends on which location you're in. But from an investment standpoint, I think, from a tax deferral, if you look at things like timberland, for instance, if you were to buy land and plant trees just for timber, that's a tax deferred opportunity because you're investing your money, you're going to harvest it in, say, 12 to 20 years, and you're going to have a long-term gain tax as opposed to an income tax. So there's several different things you can do. It just depends on how you structure it and where you're looking to invest. But yes, there's a lot of tax benefits.
So I'm kind of looking for something like a K1 or whatever, right? In the multifamily investments, they do a K1. Is there something similar to that? So this is specific to US, actually, my question.
Yeah, there are opportunities. I mean, if you're looking to invest in limited partnerships that are structured, there are other opportunities on limited partnerships where you can buy into an existing portfolio that's more of a private equity structure. That would be a K1. But if you're looking to start your own farm and make your own investment, you can obviously buy a piece of property, structure it through an LLC, and you can hire a farm management company to run that for you, and you can run expenses out of that LLC, and then ultimately at the end of the year you would get a K1 in that scenario.
And just ask who was speaking.
Sorry, say again. I think you were breaking up.
Just for the recording, could we ask who just asked the question?
Yeah, so this is Vishnu here, actually. Yeah, Vishnu here.
And we've got a couple of questions that are queued up on the text chat also.
Oh, okay. Sorry, I was sharing my screen. I couldn't see them.
Oh, yeah. No, I'll read them off for you. And feel free if you want to put your questions there, or, feel free to speak up and ask them just, over the audio. So the first one here is by Anatha. So what is the average return for a passive investor in this sector?
Great question. That really depends on where you are in the supply chain, right? If you're looking at, and it also depends on if you're talking about pure farming related investments. It depends on what type of crop you're in. You can think of it like this: the shorter time to first harvest, the lower the return. So if you look at things like corn or soy that are 6 months to a year in harvest, you're probably going to be at, like, if you're talking about domestic investments in the U.S., you're looking at like 4 to 6%. So not very high on those. But if you go into tree crops, that maybe take 3 to 4 or 5 years, or even 6 years, 7 years, if you get into nut businesses like walnuts and cashews and things like that, it's much higher. You can be easily over 20% annualized in that type of business. Now, if you start from scratch, you would have to wait the initial time period for that first harvest. But once they start to harvest, typically the tree crops, they're going to pay out a minimum for 10 or 15, 20 years, depending upon where you are, and you're going to have that opportunity. But it all depends on the location. In the emerging markets here, our rate of return on our limited partnerships that we've structured range anywhere between 8 and 22, depending upon what type of product we're in.
Okay, the next question is from Halad, and he is asking, how do you protect from natural disasters like flooding and famine?
Also a great question. That really goes into the due diligence of the product. I mean, one of the most important things is obviously access to water. So the first thing we're typically doing are water studies, soil studies. That's kind of a prerequisite before you even engage in any negotiation on a deal, is making sure that you have those things solidified. Natural disasters, obviously, that has a lot to do with location. The Caribbean has a lot of problem with this. Like, for instance, we've evaluated projects in the Dominican Republic before. Pineapple farms there. They also have lime farms as well. Issues with, we never went forward because of that issue and the hurricane cycles. Staying out of the hurricane belt if you're working in the Caribbean. There's some things that are just unforeseen, but if you're in the Midwest, for instance, in the U.S., you've got things like tornadoes, but those are few and far between, but it is a risk, and you can add typically some type of crop insurance for some things like fires or other things like that. And we have looked at that as an option. We don't currently use it because our farms are in unique locations, but it's an option to protect yourself.
I'm going to add to that question. Is there a futures market or some sort of commodity market where you can offset and hedge against some of the risks?
Again, it depends on. There are in the true commodity businesses, you can hedge yourself in the public exchanges by doing that. If anything that's traded in Chicago on the futures markets can be theoretically hedged, and you can insulate yourself if you're looking at development. But I mean, if you're looking at the tropical space, there's not really a public businesses.
Okay. Shantesh is asking, what's the minimum capital required to invest in this sector?
Again, that depends on product, and region. But if you're looking to buy a farm and develop it, I would say the range would be $250,000 up. I mean, obviously you could go as high as you wanted to based on the size. You could look at probably buying small farms with decent cash flows and getting an offtake agreement for somewhere around that space. There are new opportunities that are starting to come up that we're actually investigating as well that have essentially fractionalized farms. So one big farm is essentially being subdivided, and then a management contract is signed with an offtake agreement. And those are around 50,000. So if you're talking about doing it yourself, I'd say no less than $250,000. If you're looking to buy into, kind of like a co-op arrangement where you're just buying a piece of land and somebody else is managing it for you, you could probably get it in the $50,000 range.
All right. Anatha is also asking, what are active investment opportunities available in California? What are resources where we can find more details?
Yeah, California is dominated primarily by large producers. Like I said earlier, the San Joaquin Valley, which is about 4 hours from San Francisco. You have a lot of citrus, stone fruits. You go further south, you've got avocado farms. I've actually been up in that entire region looking for investment opportunities, and the pricing in those regions, this was a couple of years ago, but the pricing of land at the time that we were evaluating was so high that the business values, it just didn't make economic sense for us to make an investment there. But, to be honest with you, I don't have a current resource for you in California. I assume you could probably do some Google searching on particular, avocado investments or something like that. Most of those are private though in California. The family-owned businesses are pretty big. You really have to be looking for land and then pairing that with a management contract. You can find farm management contracts all over California where people will do that as a service for you though.
All right, Ellie is asking the question, as a personal/private investor, if you decide to purchase land overseas with minimal education with farming, how do we ensure that the managers are being responsible in their managing?
Yeah, I mean, what you're looking for in a farm manager, especially overseas, is track record and reporting. You need to know, exactly what your costs are going to be per tree. If you're in tree crops or if you happen to do row crops like a pineapple or something, you'd want to be looking at your cost per hectare. It's fairly easy to validate a lot of that information, and a farm manager should be providing you with ongoing reports of expenses. They're typically billing you on a monthly basis for services. A lot of the services use, like for instance, drone technology. We're using that now with our farming as a service business here in Colombia, where we basically create a geo map we're able to mark the particular farm area, and there is an app that will go out and actually fly that. So part of the farm evaluation on a monthly basis is putting that in place and sending a video of the farm. It gives you actually a real-time picture or a monthly picture video of the farm. The other thing that is very important when you're evaluating, farming as an investment is making sure that you have a very solidified distribution channel with a diverse. I was talking about this earlier in the presentation. The reason U.S. farmers are struggling, most of them, is because they really only have one buyer, like a big supermarket or one big food distributor. You really have to make sure that you've got diverse sales channels, or whoever's going to be selling your product for you, which there are a lot of people that are available to sell product as well. You have a lot of people that do off-take agreements, meaning that somebody will sign a contract to buy all of your fruit at a predetermined price, assuming the quality is good. But you want to make sure that person has a diverse distribution channel, and you have to check not only the farm manager out, but whoever your sales channel is with farming. You want to make sure that they've got a very secure distribution channel, because the last thing you want is to spend 1 year waiting on a harvest, and then something happens like coronavirus, and your seller doesn't really have a great distribution channel. He's got only one option. So that would be equally as important.
All right, and Vishnu is asking, what are the key financial metrics to evaluate farmland?
Yeah, looking, you really want to run it has to do for us when we go out and evaluate, for one, where is it located? Looking at the cost of delivery to market. So the logistical cost, for instance, of transporting a truckload of something from one place to another, wherever your end destination is, that's a big factor. If you're exporting, how far are you from the port? What are your transportation costs going to be? How far are you from a major city? It has to do with, there's several different factors, but in the U.S., it's very easy to get MLS data to look at what similar properties have sold for. If you're looking at emerging markets, it's a little more difficult, and it really has to do with, it's not necessarily what is the market price, but what is the value of the property with your particular agriculture project, and what does it do to your yields based on the asking price. It's really variable by location, but I would say access to water, logistics, and product viability for what you're trying to grow.
All right, we don't have any more questions in the text box right now, so the floor is open for anybody who would like to ask.
If anybody, I'll just say that if anybody has any questions or would like to read more about this, you can download an educational guide at Farmfolio's website, farmfolio.net. Part of what's in this presentation is on that, but it's more detailed, and it has some detailed analysis on regions of production. So it's a great reference guide if anybody wants that.
So real quick, why did you decide on Colombia instead of, why did you go overseas for this instead of just looking in the U.S.? Was it mainly just financially based?
Yeah, it's a number of reasons. We actually started the company in Panama. We moved to Colombia about 6 months after we launched, and it was really because of the relationship to the peso-dollar relationship. The Colombian peso is right now, it's almost 4,000 to 1. So the first project that we were looking at actually was a coconut farm for development, and the price of the project in Panama versus Colombia, it was 1/3 the development cost in Colombia due to the relationship of the peso and land pricing. We also had, a couple of other tax incentives. As I was mentioning earlier, we don't pay any income taxes here for 10 years. And we just saw it as a tremendous, business opportunity to be here. But emerging markets, again, it goes back to labor costs, land costs, operating costs. And if you're developing your project and your operating cost is in peso and you're exporting to dollars or euros, you have a much larger yield than what you would have in a dollar to dollar relationship.
Thank you.
Sure.
Hey, Brad. Is there any opportunities like being a fertilizer or a pesticides dealer to work on agriculture based secondary? Is there any opportunities in that area?
In terms of selling inputs to farming operations, sure. There's you've got several private equity companies that operate in that space. One would be Agua Capital. They're based in Brazil. They focus on nothing but agrochemical input companies. If you were going to start and do that yourself, you'd have to have a lot of experience in that space, particularly in chemistry. But from an investment standpoint, the Monsantos, even though I don't personally agree with a lot of their practices, they're an inputs company. They do all types of fertilizers and things like that. There are public opportunities for that as well.
Thank you. Thank you.
All right, are there any more questions? Well, if that's the case, then Brad and Dax, I just wanted to thank you very much for coming in and sharing your expertise on farmlands down in Colombia and South America. It's been really informative. And of course, if people want to get in touch with you, it's at farmfolio.com. Do you want to just reiterate your main contact method, whether it's email or phone or whatever it happens to be?
Yeah, this is Brad. You can reach out to you either go to the website and download the guide like Dax said, so farmfolio.net. You can email me directly, brad@farmfolio.net, or my cell number's on the screen too, so 231-412-2102. You can feel free to just call me directly, whatever you prefer. Doesn't matter to me. And then we'll get, if I don't answer, we'll get back to you as soon as we can. But we appreciate you guys taking the time. I know it's your lunch, so and thanks for putting all this together, Daniel. That was fantastic.
Oh, thank you. And so just a quick announcement for next week. We've got a special guest named Whitney Sewell. He is a prolific podcaster. He does a podcast every single day on his real estate syndication show. And so far, he's interviewed over 500 people. We're actually going to be switching to a slightly different format. Intel's video porthole video service has allowed us to come on and do our broadcast there. So I'll be sending out detailed instructions next week on how to connect next week, but it won't be over Skype. So it'll be through the video portal services, which I believe is a web-based player. So it'll be a little bit of a transition, and we're also going to place a circuit article in order to see if we can get some better reach. But the main way that we reach out to people is just by word of mouth. So if you've appreciated this and you've gotten good info from it, please share it with others, because our ability to attract top quality people like Brad and Dax depends on our ability to bring in a good group of people. So please share it around, and I hope you have a great weekend. Thanks, everybody.
Thanks, everybody. Thanks, Daniel. Bye.
Thanks for all that information. It was really, really thorough.
Thank you.
Yes, thank you very much.